Hello, everyone. Grayson here with SES Services. Every week, I like to put out a market update, get some information out of the financial press, and go a little bit further into investigation. This week, we're going to talk about the $1 trillion secret. Okay, so central banks around the world are raising interest rates. They're tightening monetary supply, or so they say. And the world's financial markets, stock and bond markets, have taken on a little bit of water as compared to the high print in, say, late 2021. But things are actually holding on pretty well. And we've talked about that repeatedly here on our weekly podcasts, that especially here in America, the situation is holding together pretty well. We've got some decent economic numbers on one side. Some of the economic numbers are pretty bad on the other. But in general, it's not a train wreck. And no one reasonable a year and a half ago would have thought that our central bank could raise the discount rate, over 4.5%. And that things would be holding together as well as they are. So it kind of lends for some questions. Is there anything going on behind the scenes that we don't know? Because one of the biggest things, just to show, and I've shown this in previous updates, but the inversion of the yield curve with all this going on, front-end interest rates are so much higher, and long-term interest rates really aren't matching. So what you're looking at right here is the 2-year treasury, or excuse me, the 10-year treasury yield minus the 2-year treasury yield. Looking back at Paul Volcker's Saturday night special, the inversion of the yield curve. Short-term interest rates much higher than long-term interest rates. Well, back in the early 80s with Volcker, it was about 2% higher. Now I'm not really sure how far we're going to go down. The tightening of the front end of the interest rate curve is interesting. We'll see if the system can hold together as well as it has been. But one of the things, and we titled this week's update, "The $1 trillion Secret." One of the things we figured out is actually the Central Bank of China has been pouring a ton of liquidity on the open financial markets over the last couple of months. That has at least some of the answer for why financial markets are holding together pretty well. I mean, when you think about it intuitively, especially from the fact that the Central Bank of China has their currency, the yuan, they have it locked to the US dollar. It's gravitated between 6 and 7 yuan to the dollar for quite some time now. So if I were a central banker in China and the US raised rates to where we have, well, what if I just printed a bunch of yen and started buying front-term interest rate products from America? So I could just print yuan and buy treasuries and make 4.5%. Well, apparently that's, at least to a degree, some of what they're doing. It does make a lot of sense. So financial markets are holding together pretty well. But the reason, titling today's talk, "The $1 trillion Secret," that the Chinese, rather than tightening, are actually dumping liquidity on the market. One of the reasons I put this inverted yield curve up here is because that is historically such an accurate indicator of economic recessions, either in the near term or somewhere down the road. You look at the gray shaded area on this chart, the early 1980s, early 1990s, early 2000. Everybody remembers 2001, 2002, 2003. And then, of course, 2008 and 9. Well, you notice in all these, there's an inverted yield curve right in front of that recession. And wow, here we go. We are quite inverted and getting more inverted. Federal Reserve came out today and talked about going to raise even more here in March. So we're getting more inverted. Does that mean we've got a giant recession coming? A lot of people are assuming it does. The Chinese are printing money to try to avoid it. No, obviously nobody knows. So what we're showing today is kind of two sides of the coin. Such an economic indicator with historical accuracy, like an inverted yield curve predicting a recession, and it's always hard to say, hey, this time it's different. Always difficult, because those are some famous last words. So while we have mentioned repeatedly, we think that financial markets are holding together quite well with such higher interest rates, and the economy in general. Chinese at least have some to do with that, with their printing of money, more than $1 trillion in the last month. It's absolutely crazy, but they're doing it. So on one side of the coin, we have more liquidity. On the other side of the coin, we have an inverted yield curve and the Federal Reserve removing liquidity. It's just, with a chart like this, it does make it a little bit difficult to get excited about piling into risk assets. Other people can see this chart too. Some of it's already priced in. We've mentioned repeatedly we thought the negativity was overdone. But the markets in general, when you can go get 4% on a savings account now, you can take your time adding to risk portfolios. Sooner or later in here, and we've mentioned it in the last few weeks, the Federal Reserve is going to have to come out. They're going to have to admit that they don't have complete control over inflation. They're going to have to accept higher inflation, because with some of the breakdown in the world economic situation, that's not going to change. And it seems to us that when the Federal Reserve comes out and talks about accepting higher interest rate or higher inflation rates, we'll likely see quite a rally in asset prices. Tough to buy after the Federal Reserve says that. Always good to have a well-positioned portfolio going into news. If you feel like your portfolio is over-leveraged, over-risky, again, we've had some good rallies, and the market's held together pretty well. You're getting an opportunity to lighten up right here. And you can go buy some guaranteed interest rate products at 4 or 5%, something like that. Hey, so I hope you enjoyed the information. Try to put it out every week. Feel free to reach out to us if you need some help with your specific situation. Be happy to sit down with you to a no obligation consultation. Just send us an email or give us a call. Smash the like button below here on YouTube. Subscribe to our channel, forward to others. Appreciate your time and hope to see you back next week. Thanks.